Good morning, everybody. I'm going to cover some business and corporate tax changes to start off with. I'm going to start with capital allowances. Capital allowances this year, not many changes to speak of. The annual investment allowance remains at £200,000. It's been set at that level since January 2016, and we're not expecting any massive changes of that in the short or medium term. I think the only thing to add here, that first-year allowances, 100%, are now available for electric charging points, and that's for expenditure incurred on or after the 23rd of November 2016, and that extends for a limited period through to April 2019. This is clearly linked to the government's ongoing desire to have fuel-efficient cars. Corporation tax rates, despite the Brexit vote and everything else, it's really good to really see that the government are sticking with their commitment to reduce the corporation tax. So corporation tax, regardless of the level of profit, falls to 19% from the 1st of April this year, and they're continuing with their announcement to reduce it down to 17% from 2020. So how does this compare with rates around the world? Well, the G7 average is 30.21%. Worldwide is 22.49%, the OECD 24.66%. As the Chancellor says, Britain is open for business. They want it to be a competitive corporation tax rate and a good place to be setting up and running your business. And this is set to continue. Some other points on corporation tax. Quarterly instalments. Just a reminder here, no main changes on quarterly instalments, but just to remind you that the limits of 1.5 million and 20 million are two key limits there in determining whether you fall within one of the two quarterly instalment regimes that we have, and that includes worldwide profits if you're part of a worldwide group. So please make sure that you are complying if indeed you need to. Some other changes, changes to loss relief. Some welcome changes here, because historically we've had a position whereby if a company makes a loss on a particular source of income, they can allocate it against profits of the same company in the same year or group relieve that loss. But in carrying it forward, there's been a restriction in that it had to be against the profits of the same type of income within the same company. So any losses that are created from April 2017 can now be carried forward and set against the wider profits of that company, or indeed for group relief purposes as well. We're now seeing where you have an overdrawn loan account and a Section 455 tax charge on a participator loan is now charged at 32.5%. There's no change in the rate announced in the budget, but as this is for loans advanced after April 2016, we're now seeing the first of those loans and the first of those tax charges at the 32.5% rather than the historic 25% coming through. We've got some changes to substantial shareholding exemption. Substantial shareholding exemption is a really effective tax relief where a trading company has an investment in a further trading company, whether it's by way of subsidiary or just a 10% holding or more. And there's always been a rule whereby the investor company needed to be a trading company both before and after the sale of the trading subsidiary or the interest in the trading subsidiary. That is now changing, so from the 1st of April this year, you don't need to be a trading company as an investor company, and you don't need to be part of a trading group either. So some welcome news there. Appropriations to trading stock, where you have an asset which is an investment asset which is standing at a profit, you can transfer across to work in progress and make an election to defer the tax charge arising on the uplift in value as it passes across to work in progress. There have been some tax abuse here whereby people have been trying to claim losses where assets have been standing at a loss rather than a profit, and they've been using them sideways and using them against trading losses, and this is what they've now blocked in the budget yesterday. Corporate interest exposure. We're looking at large companies and large groups here where their net interest expense exceeds £2 million, and effectively that's now going to be restricted to 30% of their EBITDA. This is part of the government's ongoing strategy to make sure that they're aligning the location of taxable profits with the location of the economic activity. So they're making sure that within the UK, a company is not getting excessive relief for any of its worldwide interest expenses. Research and development, a few slight changes here. We have some new provisions from the 1st of April where companies are working collaboratively on an R&D project to make sure that they're not disadvantaged in any way. So that's good news. That also applies to the patent box regime as well. And they also announced that they're going to reduce the administration burden in making a claim for R&D and a claim for R&D tax relief. Now, we haven't seen that document yet. We don't know what that document is going to say, but I think that'll be a very welcome change. Historically, it's been quite difficult to make R&D claims. HMRC have not been terribly organised about it, but they are getting their act together. We can now get advanced clearance as to whether a project may or may not qualify. I think the important thing to say here is that here in the UK, we lag behind on our investment in R&D. We spend about 1.7% of the GDP on R&D, and within the G7, our competitors are doing far, far more than that. Japan is spending more than double that, Germany 2.87%, the US 2.75%, France is above us, would you believe, at 2.28%, and Italy struggling down below us at 1.33%. So clearly there's an ongoing strategy to make sure that we are spending more and investing more in R&D. Moving on to avoidance and evasion, still features very heavily this year. It's in the press, you know, a week doesn't go by without hearing something. And just to focus our minds on that, we have a tax gap for 2014-15 of some £36 billion. That represents 6.5% of the UK's total tax liability. So what we're saying there is that we know the tax bill should be a certain level, but the amount they actually collect is some 36 billion short. They've said that because of their anti-avoidance rules and the action they've taken since 2010, a further 140 billion has been collected already, but that's not enough. There's over this Parliament, we're seeing 35 measures in total to tackle and combat avoidance, evasion, and any aggressive tax planning schemes. We're trying to have a fair and competitive tax regime, and that's the headline that the government is trying to say. Final subject I want to just touch on today was making tax digital, MTD. HMRC are very focused on making sure this happens. They've announced it last year, and they've said the start date will be April 2018, and there's been an awful lot of lobbying, particularly by the Chartered Institute of Taxation and other sectors, to say this is not feasible, it's not possible, we're not prepared, we don't know what we're doing. And I think, to be fair, I think all of those are fair comment, but the government are pushing forward. They're saying it is going to happen. It is going to happen from April 2018 for self-employed people, for partnerships and for landlords. Where a business is below the VAT threshold, there will be a further year of delay through to 2019, and that was announced yesterday. VAT goes digital in 2019 and corporation tax from 2020. In addition to that, from April 2016, we've all been set up with a digital tax account, so we can all log in and have an app to get into the HMRC. Doesn't particularly appeal to me. I have to say it's not the new Angry Birds by any means, is it? So reporting requirements. So from April 2018, we know that self-employed people and landlords are going to have to report quarterly. Now, they can use spreadsheets. We've been told they can use spreadsheets. But we know the spreadsheets will need to be will need to interact with MTD at the revenue, and the revenue are not going to be providing any software to facilitate this. So it's going to be third-party software is going to be needed to actually report on the revenue side. Quite surprised at that, but the government have confirmed they're not supplying any software to facilitate this. HMRC seem to be quite deluded in thinking that if people are filing quarterly, they want to pay their tax quarterly. I can't imagine why anybody would want to do that, but they're still pushing forward with that belief. The submission deadline is 1 month after the end of each quarter, and then you have to go back after your year end, and within 10 months make sure that you've adjusted your accounting profits for taxable profits and finalised everything. And I don't think they've quite thought this through, because if you've got an April 2018 year end, by way of example, you're going to have a difficulty there, because you're going to be trying to finalise your last quarterly return. Within 10 months you're going to be making it final, and at the same time you're still going to be doing the previous year's tax return and paying the tax, but not the tax on the profits you've just declared, but on the previous year, and that's setting your payments on account. I suppose what I'm saying to you is January 2019 is going to be a dreadful time in the tax world. We've cancelled all holidays. No one is going to be allowed anywhere, I'm afraid. Now, I think the only thing I would say, we'll skip forward a little bit there, sorry. The only thing I would say is that at Scrutton Bland, we've been looking very carefully at making tax digital, and we are making sure that we're ahead of the game on that. So we are trialling software, we are integrating with our software suppliers, and we are beta testing that to make sure we're ahead of the game and to make sure that we're going to be prepared for those deadlines that the revenue seems so insistent in pushing forward. It will also interact extremely well with our cloud accounting proposition. So the SB Live product that we launched last year will be integrated very closely into making tax digital. So we're ahead of the game.